Welcome back to the Michael Gaddis Show. I am your host, Michael Gaddis of www.michaelgaddis.com. I am also the CEO and NMLS license broker of Frontier Loan Group, Inc., or as we like to call it, FLG. FLG is licensed by the California Bureau of Real Estate, license number 01449152, NMLS ID 345305. I am also licensed by the California Bureau of Real Estate as a real estate broker. My broker license is 014338800, and my NMLS license ID is 280011. Today, I want to talk about the myths and misconceptions of one of the most enigmatic loan products on the market today. I call it enigmatic because there is so much misinformation about how this loan really works. There is so much. Last week, I spoke a little bit about what a reverse mortgage is, as well as discussed about some of the general eligibility requirements. Today, I want to talk about the myths and address some of the misinformation out there about reverse mortgages. So one of the number one myths that I hear is that reverse mortgage borrowers lose title to their home. This is absolutely not true. A reverse mortgage is very similar to a forward mortgage. You keep title to the house and there's a lien on the property. So in no way does a borrower lose title to their home. Another myth I've heard recently is that since the loan negatively amortizes, and what negative amortization means is that if you have a reverse mortgage, you don't have to make house payments. But those house payments have to go somewhere, right? They just don't disappear. What happens is those house payments get knocked basically on top of your principal balance. So every single month that you don't make a payment, your loan goes up. Your principal balance goes up. So that's called negative amortization, because a straight amortization will allow for your payments to go down as you make payments. So since the loan negatively amortized, the loan balance could exceed the value of the property, making the borrower and the heirs responsible for the deficiency when the reverse mortgage becomes due and payable. This is absolutely not true. Reverse mortgages are non-recourse loans. And as we discussed earlier, a non-recourse loan is where the only option that the lien holder has is in the house itself. It cannot come after you or the heirs or anybody individually. So, in fact, and here's something very interesting about this, because, let's say, for example, this situation arises, which is a good thing, by the way, because the way they calculate how much you're going to owe is based on your life expectancy. So if you're in this situation, more than likely you've outlived your life expectancy, which is a good thing. And what it means is that there's an avenue for your heirs to purchase the home if they wanted to retain it. So let's say that you pass away, you owe a lot more on the house than what it's worth. The heirs have the option to purchase the home at 95% of the market value. So that's a really nice option. No matter how much the house is worth, whatever the market value is, they'll let you buy it for 95% of the market value. Myth number 3 is the heirs will not receive any of the remaining equity when the reverse mortgage becomes due and payable. The truth is, when the last reverse mortgage borrower dies or ceases to live in the house for more than 1 year, the borrower or the heirs can either pay off the reverse mortgage or sell the home and pay off the reverse mortgage balance from the proceeds of the sale. Any amount above and beyond the reverse mortgage payoff will go to the borrower to the estate of the borrower. So, as long as basically, there's equity in the house, when the house is, it's just kind of like if somebody passes away with a forward mortgage. You'll sell the house and you'll pay off the loan. It's the same thing. Myth number 4, homeowners that have not paid off their house cannot get a reverse mortgage. This is absolutely not true. One of the key components of a reverse mortgage is that you either have a paid off house or a house with a substantial amount of equity. The reason that lenders and investors like these are that they're very secure loans. Because of the amount of equity there's very little risk to them, because they know that there's a very high probability that they're not going to be in a negative situation. Myth number 5, borrowers with conventional loans secured against their property cannot obtain a reverse mortgage. The truth is that, so it's kind of the opposite of the previous myth. In this situation, someone's saying, well, if my house is not paid off and I have a loan, I can't get one. Well, that's not true. What happens is that when you get the reverse mortgage, a reverse mortgage will pay off the existing loan and allow you to get a reverse mortgage within the confines of the LTV restrictions. Myth number 6, a reverse mortgage can cause you to be evicted from your home. The bottom line is, as long as the borrower continues to pay for the property taxes, homeowners insurance, HOA, and property upkeep costs of the property, the borrower may live in their home for as long as they live or continue to live in their home. No one has the ability to force the borrower from their home. A lot of times, this kind of myth comes out when you have maybe a child that's living with the homeowner, and sometimes what happens is when the person passes away, the child who's living there basically doesn't tell anybody about it, and sometimes it can cause some problems. But that's a different story, and that's about understanding what a reverse mortgage is, the errors at least, and being proactive about it. But the borrowers themselves can never be evicted as long as they're living in the house. Myth number 7, if the borrower if the borrower outlives their life expectancy, the reverse mortgage lender can make the reverse mortgage due and payable. Again, it doesn't matter. You can outlive it. So basically what they're going to do when you get your reverse mortgage is they're going to have a life expectancy. And after your life expectancy, basically you can still continue to live in that house until you pass away or continue to live there for at least 1 year. Now, in this situation, it could be possible that by the time you do pass away, let's say you live to be 110 years old. Let's say your life expectancy was 20 years and you outlive it by 15, 20 years. You could be substantially underwater by the time you pass away. But they can't take your house or say, oh, sorry, you're out. It doesn't work that way. They can't do that. Myth number 8: reverse mortgage lenders take advantage of senior homeowners. This is a big misconception. Seniors that have been scammed or misled by reverse mortgage are the exception to the rule. The reverse mortgage loan program requires that borrowers contact an independent third-party HUD counselor that explains how reverse mortgages work, as well as the pros and cons of obtaining a reverse mortgage. So what this means is that no one can be duped necessarily into getting a reverse mortgage. There has to be an independent counseling session that occurs from a third party, and that third party is going to go through line by line and explain exactly what is going on to the homeowner. So the ability of somebody to scam a homeowner is negated by this requirement that there's an independent third party to advise them. The next myth is that there are restrictions on how money received from a reverse mortgage can be used. And the reality is that there are no restrictions on how the money can be used. You can use it for whatever purpose that you want. And however, borrowers should be prudent on how they use reverse mortgage proceeds. Because it's important to make sure that you're wise and prudent in how you use these funds. Myth number 10, reverse mortgages are only utilized by desperate seniors that did not plan well for retirement. And that's not true either. A lot of homeowners use reverse mortgages as part of their retirement plan. I mean, the reality is that the golden years of your life are supposed to be golden. And I know that sounds like a cliche, but it is true. And, when you're living on a fixed income filled with just, let's say Social Security or a restricted pension fund, you don't have the flexibility to do things that normal people would like to do. I mean, you plan your whole life to retire and travel and see your children and grandchildren and go out to eat, go to movies. You want to be able to do all of those things. However, a lot of times, reverse mortgages, homeowners cannot do that because they're restricted, but yet they're sitting on a either paid off house or a house that has a substantial amount of equity. So there's a lot of potential value in in reverse mortgages. But it's important to note that reverse mortgages are best performed on a case-by-case analysis. It's impossible for me to sit here and tell everybody universally that a reverse mortgage is right, because it might not be. There are situations that I've come across where I just did not think it was the prudent thing for them to do. And so, I think, as I said, it's more of a case-by-case analysis. And so if I think people kind of look at their own individual financial circumstances and kind of look at the benefits and the points of consideration with the reverse mortgage, they can easily make a determination of whether it's right or wrong for them. Well, that does it for today. I want to thank you all for listening to the Michael Gaddis Show on AM 1170 The Answer. I am here every Wednesday night at 8 p.m. discussing anything and everything related to real estate. If you want to contact me with questions or topics for the show, please feel free to email me at michael@michaelgaddis.com, or you can call me at 888-242-2272. And you can visit my Facebook page at www.facebook.com/Michael Gaddis Realty Group, or visit my webpage at www.michaelgaddis.com. Again, you have been listening to the Michael Gaddis Show on AM 1170 The Answer. Good night, San Diego.